Singapore's home loan rates are expected to remain steady, according to analysts. This after the US Federal Reserve's decision to keep interest rates unchanged for now. Some economists also believe the 3-month SIBOR benchmark lending rate may have peaked at the current 2%. And this may bring down some relief to borrowers.
The U.S. Federal Reserve's decision to keep interest rates unchanged is a relief for potential homebuyers. Any direction taken by the Fed is likely to have a trickle-down effect on the Singapore Interbank Offered Rate, or SIBOR. Many banks in Singapore also use the SIBOR as a benchmark rate for home loans. With the Fed's current stance, experts say SIBOR rates should remain stable in 2019.
Singapore is a price taker here. Pretty much we're seeing our benchmark interest rate SIBOR, the likes of which takes after what we have in other central banks overseas and US in particular, our major trading partner. So in that sense, actually, while the SIBOR itself sometimes does actually preempt the moves from the Fed, and in this case, we've certainly seen the Fed now actually been shifting the expectations. I think pretty much likely we're going to see when the Fed themselves may move, but the market may likewise be seeing that kind of trending downwards in terms of our interest rates as well, in line with that, and likewise for the borrowing costs, I think it's expected to go lower.
Historically, SIBOR rates have been trending up since the end of 2014. In 2019, the 3-month SIBOR rate has hovered between 1.8 and 2%, while mortgage rates are between 2 and 2.7%, according to the Association of Banks in Singapore. Higher SIBOR rates means a higher cost of borrowing, which analysts say is among the reasons behind the slowing demand for housing loans. According to data from Singapore's central bank, outstanding housing loans were stagnant in the first quarter this year compared to last year, and new housing loans also slumped 30%. Analysts say cooling measures, among other factors, have also dampened the property market.
Mortgage loans are a function of many other things other than the price and cost of borrowing. It could be things like the on-lock cycle. It could be things that maybe people are not that comfortable buying property at this time, or it could be things like new launches. So there are many factors impacting the mortgage loan growth. So I wouldn't necessarily attribute that much of an impact to just borrowing costs.
Lenders like OCBC believe SIBOR rates may have reached its peak.
If you look over the last 12 months, obviously mortgage rates have been creeping higher in response to the rising SIBOR rates as well. Now that the SIBOR has stabilised and looks like it's going to probably not climb significantly higher from the 2% handle, that should provide some relief to mortgage borrowers.
While the US Fed is staying pat for now, it has also indicated it could soon cut interest rates.